in Sierra Corporation by investors in exchange for $10,000 of common stock. What's going to happen here? Cash goes up and common stock goes up. Next, on October 1st, Sierra borrowed $5,000 from Castle Bank by signing a 3-month 12% $5,000 note payable. What's a payable? Liability. Cash is going up, but a liability is going up. Okay? Next, on October 2nd, Sierra purchased equipment by paying cash of $5,000 to Superior Equipment Sales Company. What happens? Something's going up and something's going down. Cash goes down and equipment goes up.
But still balances.
It has to balance. They're both assets, so the assets remained unchanged, but the components of the assets changed.
Just moving it from your left pocket to your right pocket.
Correct. Next, on October 2nd, Sierra received a $1,200 cash advance from R. Knox, a client.
Unearned service revenue.
Goes up. And what else? Cash goes up. So our cash goes up. Our liability, unearned service revenue, goes up because we haven't earned that money yet, so it's a liability until we do the work. Okay? Next, on September 3rd, Sierra received $10,000 in cash from Copa Company for guide services performed. Two things go up here. Cash, revenues go up, and cash goes up. On October 3rd, Sierra Corporation paid its office rent for the month of October in cash, $900. Cash goes down.
No, it's payable. It's expenses. Oh, it's
Expense goes up. Rent expense goes up. Where am I? There. Now, rent expense goes up, but let me clarify that. It's reducing our stockholders' equity section because we're taking away from stockholders' equity, aren't we? We're using it. The next, on October 4th, Sierra paid $600 for a 1-year insurance policy that will expire next year on September 30th.
So cash goes down, prepaid insurance goes up.
Cash goes down, but prepaid insurance is going up. It's a prepaid insurance because we haven't used it up. Okay? The next, on October 5th, Sierra purchased an estimated 3 months of supplies on account from Aero Supply for $2,500.
Accounts payable and supplies.
Awesome. When it says the word on account, that means we haven't paid it. Awesome. It's a liability. So the liability goes up and our supplies go up. You will always know, guys, if it's on account or if it's paid by cash based on exactly that. Purchase supplies for cash or purchase supplies on account. That means it's a liability until we pay it.
So on account is basically put it on my tab.
Correct.
Okay.
You bar tab, put it on my tab.
I know.
I'm in my
what you-
20s still, come on.
Wait, think they stop when you get older? You still get tabs.
They just get a lot bigger. Well, depending on how often you go.
Especially when you have a daughter that goes to. Here, let me shut.
Exactly.
I got it. Okay, so now we've got the next one is on October 9th, Sierra hired 4 new employees to begin work on October 15th.
Cash?
No.
Nothing.
No.
Nothing. An accounting transaction has not occurred. We're
Ma'am.
economic sources exchanged. On October 20th, Sierra paid a $500 dividend. What goes up? What goes down?
Dividends.
Dividends basically reduce stockholders' equity, and cash goes down. So the dividends account goes up, but dividends reduce stockholders' equity. Okay, there, dividends. Then, employees have worked 2 weeks, earning $4,000 in salaries, which were paid on October 26th. Cash goes down. The expenses reduce stockholders' equity, but it increases your expense account, but it reduces stockholders' equity. So the cool thing is, assets still equal liabilities plus stockholders' equity. When we take into account all of our additions and subtractions in cash, we come up with the total, 15.2. When we do that with supplies and prepaids and equipment, we have 23,300. Then we go over here and we look at our liabilities and our stockholders' equity, and we balance all those out. Look how our 23.3 equals our 23.3. Isn't that cool? It's the accounting equation. Assets equal liabilities plus stockholders' equity. So, we're going to get into now the details of the accounting system. The account, an account being cash, being accounts receivable, supplies, building, equipment, common stock. Each of these accounts, interest expense, prepaid insurance, each of these accounts records the increases and the decreases in assets, liabilities, equity, revenues, or expenses. Those are the only things we've got, right? Assets, liabilities, equity, which is like the common stock, revenues coming in or expenses going out, okay? We use an account as a great way of designating how they go up and down by forming what we call a T account. A T account is just what it says. It looks like a T, and it has an account name, and there's a side that's called a debit side, and then there's a side called the credit side. Now you are going to see this on your quiz come chapter 3. It's going to ask you, a T account has 3 parts to it. What are they? The account name, the debit side, and the credit side. Now, some people really get stuck on this, but we're going to not get stuck on this because some people think a credit means increase and a debit means decrease, or a debit means increase. No. Debit means left, credit means right. Okay? That's all it means. So, what I won't like bore you because you get sick of it, but here's our big T account. And it says cash. That's the account name. This side is the left side. We just term it DR. I think it's a Latin term. And this side is credit. So, what does debit mean?
Left,
Credit?
right,
Right, left, right.
positive.
No. Debit means left, credit means right. That's how we set up accounts. Guys, you're going to see this. Debit means left, credit means right. Period. Okay? So when you hear a T account has 3 items: account name, a debit side, and a credit side. Okay? The reason I do this on the board, because I want you to start visualizing left, right, left, right. Debit just means left. Credit just means the right side. Okay? Now, when we go and process all these various transactions, each transaction is going to be affecting a minimum of 2 accounts. A minimum of 2 accounts, and the way we're going to record them, there is going to be a minimum of 1 debit account and 1 credit account, because every account has to balance out. So debits must equal credits on every single transaction we perform. How does that work? For an example, when Joe invests money into a company, cash increases and capital increases or equity increases. So we've got to debit one side, we've got to credit another side, okay? The way we know what the normal balance of an account is, if our debits consistently are greater than our credit balance, or if our debits total and then we total our credits, and if we end up with a debit balance, then the normal balance on that account's a debit. However, if our credits are greater than our debit totals, then we're going to have a normal balance of that account's a credit balance. Make sense? So what I mean by that is, here's cash. We've got various transactions we're recording. 2,000, 3,000, 1,500. This totals 6,500. On the credit side, we have 500, 600, 1,000. This back side is 2,100. 6,500 minus 2,100 ends up with a debit balance of 4,400. This account, because the debits are greater than the credits, we end up with a balance of 4,400 in this account. Make sense?
How did you know to put them on the debit side?
I put them on both.
How do you know, do you have a tip for knowing whether it's going to be a debit or a credit?
Absolutely. But what I'm trying to show you is that when you total the debit side and you total the credit side and you come up with a balance, if the cash account has 4,400 balance sitting on the debit side, then that means cash has a normal debit balance. Okay? So, and we'll talk about that. So, here, as you can see here, when we show that the debits here are 18,000, the credits are 3, you subtract 18 from 3, we end up with a balance of 15,000 on the debit side. So this particular count, we would say, has a normal debit balance. If we deal with this particular account, do you see here? One side has 11,000, one side has 10,000, but it ends up with a $1,000 credit balance, then we would say this account has a normal credit balance. So, how does this work? Aaron, he just has to know. So, assets will always be a debit balance. You know your little cheat sheet? Let's go back to this little cheat sheet a minute. This little cheat sheet, I want you to say